The topic of today's lesson, the first lesson of this morning, is the microeconomics of investing. This is how can we evaluate, how can we arrive at some intrinsic value to for the financial assets. So yesterday we end our session summarizing that value investing is the art or the discipline of finding excellent businesses which are selling at bargain prices. So today we will focus on what we can understand by an excellent business and how do we know that that excellent business is being sold at prices which we can consider bargain prices. Okay. Excellent business. Well, in order to know whether a business is creating or not creating value, as we tried to see yesterday, we cannot only rely on the profits or the net income of that business, because you have to recall that every investment has a cost of capital. So, in fact, you may be destroying capital even if you are obtaining profits. Okay, that's an idea that's very important, because we tend to think that every business which is obtaining profits, it's creating value, and that's not necessarily true. You may be destroying value even with profits, with accounting profits. Okay, why? Because accounting profits don't take into account the cost of capital, or don't usually take into account the cost of capital. Imagine you found or you finance your business just with equity. If you finance your business just with equity, you don't have necessarily to pay anything to your shareholders. You don't have any contractual obligation to pay any fixed amount in some given dates. Okay? But if you finance that same business through the issuance of bonds, you have to make periodic payments to your bondholders. Okay? So, let's assume that you have profits of 1,000 euros, okay, and your interest payments are 1,100, okay. In this case, it's clear that you are destroying value. Why? Because you have these profits and you have to pay this to your bondholders. So you are in fact having losses. But imagine that this same business, instead of financing it with debt, you finance it just with equity. You will have 1,000 euros of profits, but you won't have any explicit payment to make. You don't have the obligation to do any explicit payment. But can we say that this business is not destroying capital, is not destroying wealth, because he has not the contractual obligation of doing any payment? Remember that yesterday we explained that the cost of capital of equity is higher than the cost of capital of debt. Why? Because debt is a more secure payment, more regular payment. Equity is just you earn what's remaining after having paid all your previous obligations. So if the cost of capital of equity is higher than the cost of capital of debt, even though you don't have an explicit payment to make, you do have an implicit obligation to make payments. You have the implicit obligation to compensate the saver and the investors who have put money into your business for that money that has been invested. Okay? So if you are not able to cover the cost of capital, we don't know which would be the cost of capital. Let's assume that equity is €100,000. If the cost of equity would be, I don't know, 5%, which is not an absurd estimation, as your return is just 1,000 over 100,000, this is 1%, you would be destroying value. It's like I asked you, would you invest in a business that offers you a 0.1% of return per year? You wouldn't. Why? Because you would say, even without inflation, okay, just in real terms, you wouldn't. Why? You would say, I prefer to have that money available for any other uses before investing, instead of investing in some business that provides me a 0.1% of return. A 0.1% of return, it's a profit. It's an accounting profit. It's a tiny accounting profit, but it's a profit. Okay? But you would be destroying value. Why? Because you as a capitalist would not obtain enough money in order to compensate yourself for what? For the time preference and for the risk aversion you are suffering because of being in that business. Okay? So, not every accounting process, every accounting profit is economic profit. You can have economic losses while having accounting profits. And why? Because accounting does reflect the cost of capital when it is debt through interest payments, but accounting does not reflect the cost of capital when it is financed through equity. And that's a real cost that we must take into account. In order to solve this limitation, some authors have developed what is called the economic value added. Okay? What's the economic value added? It's a way of trying to measure the economic impact, the economic profit you are obtaining after subtracting the cost of capital. The cost of capital not just for interest payments but also for capital payments, or let's call equity payments. Okay? So we can define the cost of capital, economic value added, EVA, as the difference between the return on capital employed minus the weighted average cost of capital times the capital employed. Okay. I will go now into a little more detail on each term of the equation, but I think it's very important to realize through this formula which are the ways in which a business can create wealth, can create economic value. Which are these three ways or four ways? The first way is to invest in projects which have a higher return on capital employed. The higher the return you obtain, the higher the economic value added you create. Okay, so the first way, it's the most obvious, which is if you want to increase the wealth you are creating, invest in projects with a higher return. This is the mainstream way of doing that. The other possibility for creating wealth is to reduce the cost of your capital. If you are able to attract capital from some capitalists who ask a lower compensation for being in your business, for being invested in your business, you can create more wealth with the same rate of return. Okay. Imagine you were invested with some capitalists that ask a minimum 10% rate of return in order to be invested in your business. but then you are able to refinance yourself with other capitalists at a 5%. So even with the same rate of return, you are creating more value, because those other capitalists are much better off with the same return. So first way, increasing the return on capital employed. Second way, reduce the cost of capital. Third way, to put more capital in those projects which have a return on capital employed higher than the cost of capital. Okay? So you may have found a project which has a higher return than the cost of capital. But if you can multiplicate that same project many times, replicating it in many places, even if you don't increase your return on capital employed, or even if you don't reduce your cost of capital, you are creating more wealth. This is the case, for instance, of a supermarket, of Walmart. Walmart starts and opens a store. The store, imagine, has a 20% of return on capital employed. The cost of capital is 5. So they are obtaining a 15% over the capital employed. But if you open a second store, even with the same data, even with the same rate of return and the same cost of capital, you are having that value created twice. So you are creating more value. And if you open a third store with the same rate of return and the same cost of capital, you are creating even more value. So attracting more capital and investing more capital in projects with a return higher than the cost of capital is another way of creating economic value. And the last way, which is in fact a complement of the last one, is a way that businesses are not very eager to do. They don't like it very much, but many times it's very necessary, which is subtracting capital from those projects where the cost of capital is higher than the return on capital employed. This is restructuring the business, going bankrupt, etc. These all are ways of creating capital. This last way is a way of stop destroying capital, or stop destroying economic value. Okay? So we have economic value added, which is a way of measure economic value beyond accounting, because we are taking explicitly into account the cost of capital of equity, which is not done by traditional accounting methods. One way in which maybe you can understand this better. Imagine you find a project which has a return on capital employed of 70%. Okay, and you say, whoa, wow, project. However, if your risk of losing money was, I don't know, 99%, that would be a project you should not try to achieve or to perform. Why? Because you are assuming a cost of capital which is much higher than the return on capital employed. If you don't take explicitly into account the cost of capital, this is if you just do accounting, you could say, oh, I can obtain a 70% of return on capital employed. What a great business I am about to do. But this would be an illusion. Why? Because you are assuming extraordinary risks. Playing lottery is not a great business, although the potential return on capital employed is huge. Okay? Why? Because the risk you are assuming is also very huge. So you have to correct always the return you are obtaining with the level of risk you are assuming. And in fact, we are going afterwards to see ways of reducing the risk you are exposed to. Okay, so the economic value added formula helps you to correct this, to take into account not only the return but also the cost of capital. This is of risk and of time you are invested in a project. How we do define the return on capital employed? Well, return on capital employed is usually defined as net operating profit after taxes divided by capital employed. What's net operating profit after taxes? Well, it's the profit, the accounting profit you obtain before interest payments. This is, you don't subtract from the profit the interest payments you have to make, and after paying taxes. Before interests and after taxes. Why are we interested in this accounting measure? After taxes, it's evident you have to subtract taxes. Why? Because taxes is not money you are going to keep, unfortunately. So, that's not real money you are having. If you go to a country where the corporate tax is 90%, obviously you have to take that cost into account in order to know if the project is interesting or not. So, it's obvious that you have to deduct taxes. The point is, why shouldn't we deduct interest payments? Well, the idea is that we are trying to measure how efficiently are you using all the capital you are employing. And all the capital you are employing is both equity and both debt. So, if we want to see how much wealth or how much return I am obtaining over all the capital, I cannot subtract interest payments, because interest payments is a way of paying my creditors. A way of paying my creditors through the return I obtain by investing the capital they have lent previously to me. Okay? If not, we could have very strange results. I mean, imagine, going back to the previous example, imagine you have a business finance with imagine you have a business where the net operating profit is 1,000 euros. Then you have some interest payments to do of 1,000 euros. Okay? So, if the business is completely financed through debt, we would say, if we subtract interest payments from our accounting, we would say that this business have a rate of return of 0. Now assume that this same business, with this same real structure, not financial structure, but this real structure, has the same profits. 1,000 euros of profits, okay? But as we don't have to do any explicit interest payments, we would say that this business has a rate of return of 10% over, well, of 1%, okay? Anyway, of 1% over capital employed. So, we don't want the financial structure of the business to alter, to modify what's the real return we are having for the capital which is employed. The capital which is employed is 100,000 euros, independently on how this capital has been financed, either through equity, either through debt. The amount of capital we are managing the amount of capital we are investing is 100,000. So we cannot subtract interest payments in order to know what's the real return that capital is having. Because if not, the financial structure modifies the return on the real structure, and we don't want that distortion. Okay, so in the return on capital employed, we take into account net operating profit after taxes. Taxes is certainly a cost. Interest is not a cost. It's a way of paying some of your capitalists. See it another way. Imagine you have financed this business with equity. Okay? And you say, I want to receive fixed payments. I am the owner of this business and I want to receive fixed payments. Not as a shareholder, but as a bondholder. You could replace all your equity for debt and you would be earning 1,000 euros per year. Okay? So, the same amount of cash is the one you would be receiving, but in one case, if the financial structure is just equity, you will receive that amount of cash as dividends, and if you replace the financial structure based on equity by a financial structure based on debt, you would receive that same amount but as interest payments. But at the end it's the same. You are receiving 1,000 euros per year out of the profit of the company. So the financial structure does not alter, does not modify what's the economic value which is the business creating. The financial structure is just a way of redistributing between the capitalists who have financed the business, either through shareholders, either through bondholders, the amount of economic value that has previously been created. And we want to measure the economic value that has been created, not how those profits are being redistributed between the people who have financed the business. Okay? So, we already have a definition of the numerator of the return on capital employed. Then we have to define the denominator. This is the capital employed. Capital employed is not total capital of a business, but we have, well, every investor corrects it in a way, because every investor thinks he has found the more precise definition of what's the return on the capital really employed by a business. I would warn you that there are no perfect definitions, so you have to be flexible in that definition, and depending on the business you are, you should take a broader definition or a narrower definition. But anyway, the consensus, or at least the typical operations you have to do in order to make a first good approximation to capital employed, is subtracting two things from total capital, from total assets or total liabilities, which are obviously the same in accounting. You have to subtract first the current liabilities of your business. Current liabilities is not capital which you have to pay, or it's not capital with a financial cost, explicit financial cost. Okay? If I am a supplier and I allow you to pay me 100 days, I am not earning an interest over that amount. Okay? That's a capital you as my customer are being received or are receiving, but you are not paying any return on that capital. Okay? So if I am a business, I am financed in part through my suppliers, I don't have to count that account on the capital that I am really employing. because that capital is being employed in reality by my suppliers, and are they the ones who should take that capital into account, not me. It's a cost of their business, of the way they operate. They operate by giving credit, free credit to their customers, so they should take that capital into account, but not me, who are the one who is receiving credit. Okay, so the first deduction is from total assets. You have to subtract current liabilities. Okay, the second deduction is extraordinary cash reserves. Imagine you are a business that for any reason you have accumulated extraordinary cash. You have huge amount of reserves which are not necessary in order to conduct your business. Well, in fact, that's not a capital that you need to have there employed. So you cannot count that liquid asset as a capital you are employing, because in fact you aren't employing it. Okay, so that's the second correction. So imagine so imagine you have this balance sheet, okay, and you want to calculate which is the capital employed you are in fact employing. Okay, so the operation you would need to perform is, first, you have a total assets of 350,000 euros. You have to subtract current liabilities, okay, and you would have to subtract extraordinary cash reserves. What are extraordinary cash reserves? Well, it depends on the business. Some businesses need some minimum cash in order to operate. If you have some minimum cash you need to have there, you cannot subtract that because that's some capital you need to employ. But imagine this business just needs 10,000 euros to operate. 40,000 euros would be extraordinary cash that you would have to subtract. Let's assume that all the cash is extraordinary cash. Okay, so at the end you would end up with an capital employed of 150,000 euros. Okay, so imagine this business has a return of 50,000 euros. Net operating profit after taxes of 50,000 euros. You would say that the return on capital employed is 10%. While if you had measured your return on capital employed over this broader definition of capital, this is over 350,000 euros, you would say it's less than 5%. So you would be cheated, in a sense. You would have an artificially low return on capital employed. And obviously you have to take this into account, because if you say my cost of capital is 6%, if I have calculated that my return on capital employed is less than 5%, let's say 4.5%, you would say this is not a business I'm interested in. But in fact, if it is 10%, as we have calculated it is, you would do be interested. Okay? So at the end, return on capital employed is a way of measuring how efficiently a business is using its capital. And the efficiency in the use of capital is critical in order for a business to be successful. Just some example, numerical example. If you have 10 million euros reinvested in a business with a return on capital employed of 30% during 20 years, you end up at the end of those 20 years with almost 2,000 million of euros, which is a huge increase in your initial investment. If, on the other hand, you invest those same 10 million euros at a business with a 5% return on capital employed during 20 years, you end up with 26 million. So the difference is huge. The difference of having a good business with a high return on capital employed versus a normal business with a normal return on capital employed is a brutal difference. Okay? In the first case, you multiply your initial investment by 200 times. In the second case, you multiply it by less than 3 times. Okay? So you need to focus on searching businesses with a huge with a huge return on capital employed. By the way, just a short thought on this. Many times capitalism is attacked by saying that it is based on huge businesses, that there are some companies which are managing the world because they are so great, etc. The idea many people is using managing when using this kind of arguments is that those companies were already very, very large from the beginning, that they started as huge empires, huge economic empires. That's not usually the case unless we have the privatization of a public or government monopoly. The way the companies have grown so bigger is that because they started with a small amount of capital and they achieve huge, really huge return on capital employed. So in some years of reinvesting, imagine it's not 30%, but that's 300%, which is possible in some companies. That's the case of Google. How Google started in a garage and turned a multinational company? Because he had, for many years, really huge amounts of returns on capital employed. So with a tiny amount of initial investment, you end up with a huge company. But not because the company was huge from the beginning, but because you have been very efficient on using that capital, so you obtain many profits, and the profits you obtain this year are reinvested at a 30 or 300% return on capital employed next year. And the extraordinary profits you earn next year are reinvested another time at a 30 or 300% of return on capital. So that's the way companies grow. Not so much, it's not Google say, I need 10,000 million euros in order to start my business. How many capitalists want to put your money into this business, which is a crazy idea that maybe will turn correct? That's not the way companies work in real world. Okay? So we already have return on capital employed. But let's remember, we have said you can increase your economic value added by 3 ways. One is to increase your return on capital employed. The other is to reduce your cost of capital. The way of reducing your cost of capital, one is investing in shorter term investments. The other, which is the one we are going to study, is to minimize the risk you are really experiencing when investing in a business. Okay? So, how to reduce the risk? First of all, many people in standard finance, they define risk as volatility, as the standard deviation. Okay? I think it can be a useful definition of risk in some contexts, but I would push you not to take that definition of risk in your economic analysis. Why? Assume the following. You buy a stock at time 1 for 100 euros, okay? Then at time 2 the stock falls to 10 euros. But you don't have any hurry to sell. You are not in a hurry to sell, okay? So you can wait at time 3. And at time 3 it turns out the price to be 200 euros. You would say that you have incurred in a huge risk. Well, if you can wait from moment 1 to moment 3, you haven't incurred in any risk in case you have analyzed correctly the business and you are comfortable with the perspective of that business. Okay? This is the volatility in the price. It's not necessarily a threat to you if the underlying analysis is correct. What's risk in reality? That the price never goes up from 10. So you invest in 100, the price falls to 10, to 20 or to 30, and it never returns. So you have a permanent loss on your capital. This is just volatility. But the risk we should prevent in falling in is not so much volatility. Volatility can be even an opportunity, but definite losses of capital. This is you invest and you never recover your investment. If you remember from yesterday, I said that the present value of a financial asset was the discounted value of its future cash flows. Okay? So, in reality, risk is that the cash flows you have expected to have are not coming, or some of the cash flows you have expected to receive are not in existence. Okay? That's risk, because that's some wealth you expected to receive that has not been created. That's definitely a loss. If I say, I will pay you every year 100 euros, and some year, or for 2-3 years, I don't pay, and I don't owe you that money for in the future, you just lose it. Obviously you have a capital, a definite capital loss, because I should have paid you during 2 or 3 years 100 euros, and I haven't paid you and you haven't received. So that's a definite capital loss. And that's the capital loss against you have to protect yourself. But if you have a stock that earns the projected cash flows that you have expected, and for any reason, some reasons we are going to study later, the stock falls in price, that's not a problem to you, unless you have to sell it at that moment. If you can wait, you just have to wait up to the moment that the stock goes up. And the stock, if you have foreseen correctly the future cash flows and is continue to receive those cash flows, the stock will go up necessarily. Why? Because if not, Imagine that this is a stock that receives cash flows of 10 per year. And it is receiving continuously 10 per year. So cash flows are not affected. But for any reason the stock falls to 10. Do you think it's a stable equilibrium to be on 10 while receiving payments of 10 per year? No, that's because if you buy that stock you are having a 10% return, a 100% return. Okay? So the stock would eventually go up to some amount. So you won't have any definite capital loss. But imagine you have assumed that future cash flows are 10 per year. And later you discover that they will be 1 per year. Then of course you have a definite capital loss. Because the price can fall and will fall from 100 to maybe 10. And there are not reasons to expect it will go up again in price. Okay. So this is the risk against you have to protect yourself. This is the risk of not foreseeing correctly the cash flows, the future flows of income of a business. So the point is, how can I protect myself from this definite capital loss, from not foreseeing correctly the cash flows of my business? Well, value investors suggest two strategies. The first is called the circle of competence. The second is looking for companies with a huge competitive advantage. Okay? What's the circle of competence? Well, the circle of competence is a very Hayekian intuition, which is that you cannot know everything on everything. Okay? Information is limited. We have cognitive restrictions on the amount of information we can manage. So we cannot be an expert on analyzing every business. We have to focus. We have to specialize. And we have to specialize in the knowledge of some industries. And you should, unless you find a clear opportunity, very clear, but in principle, you should restrict your investment to those industries you understand. You shouldn't try to invest in industries you don't understand, even if you are an excellent investor. For instance, Warren Buffett say, I understand how the business of cigarettes, how the business of Coke, how the business of credit cards work. I do understand all of this. And as I understand which is the business plan, which is the business structure, what's the way this business can create or cannot create wealth, I can invest comfortably in those businesses. But he says, I don't understand how Facebook works. I don't understand how new technologies work. So, as I don't understand this, as I am not feeling able to foresee the future cash flows of these businesses in 20 years' time, I won't invest in them. If you are an expert in technology and you can more or less foresee what the path of technical progress will be and why some companies are very well located in order to take advantage of the progress in technology, etc., and you think that you have found some companies that are worth of buying, that's perfect. But you have to understand very well the industry. Okay? And that's the circle of competence. Restricting yourself into those industries you can handle, you can understand. The circle of competence is, at the end, the intellectual map you use in order to understand the world. And you have some map in order to understand some part of the reality. But you don't have a very detailed map to understand every reality. So, it's essential to understand what are the drivers that are moving a business you are willing to get involved with. customers, competitors, the product, the board of directors? Can you foresee what the directors will do in 10 years' time? They are trustworthy or not? What's the regulation in that business? Can you foresee what changes in regulation will be? Maybe regulation is not very important to your business. I mean, there are industries where regulation may change, but the underlying business structure won't change. But for instance, in banking, regulation is essential. Why? Because if regulators say that things should be done in one way and not in another, as they are the ones who manage the business, they can change the competitive advantages of your business from one day to another. So regulation in some sectors, unfortunately, is essential, and if you want to invest in those sectors, you should be very aware of what's the regulation and what's the possible changes. And also the exogenous threats that may appear in a business. Okay, not related properly to the business, but you must be aware of the risk outside the business plan that can appear. So, as you cannot know all those drivers from every single sector in the economy, it's better you restrict yourself to just some sectors. It's better you to be an expert in some sectors than to know something on every sector. Why? Because what makes the difference from you or with you in respect with the rest is the degree of knowledge you have in all these drivers. Okay. Jim Rogers usually says that if you read, for instance, the memory of a company, this is one of the financial statements, which is the company explains more in detail all the operation of the year and of all the details of their accounts, you are doing more than 99% of investors just by reading the memory. And that's true. I mean, the plenty majority of investors don't read the memories. So if you want to be better than the rest, you need to have a deep knowledge of the industry you are invested in. And as you won't be able to have a deep knowledge on every firm, on every industry, it's better you to restrict to your circle of competence. Because in that circle of competence, you can, in a sense, manage the risks. You can know more or less what's the risks, and you can value correctly more or less the risk. Of course, there will be always things you cannot control, you cannot foresee, but at least that you have some good knowledge. But if you go to industries that you don't understand, one rule, fundamental rule in investing is that you shouldn't invest in any business you don't know what's doing. So before investing, you have to ask yourself, do I know how this company is obtaining profits? What's the business plan of that company? Why it makes sense? Which are the threats that this company faces, etc. In case you can answer to these questions, then you have to value if the price you are paying for the business is expensive or cheap. But you shouldn't get invested into a business you cannot understand. And in order to understand a business, you need to know all of this, of that business. And as you cannot know all of this from every business, you have to restrict yourself to your circle of competence. Can I have some Second way of, let's say, minimizing your risks. What we call competitive advantage of, or in the terminology of value investing, modes. Okay, Warren Buffett said that he wants a business that that is like a castle surrounded by a huge moat which cannot be attacked from external forces. Okay, so we are searching for moats that protect the profitability of a business. Okay. A moat is, you have a castle, what's surrounding the castle, so you cannot enter into the castle. Okay. This is. Can you foresee the future income of an enterprise in 20 years' time? It's almost impossible. Okay. But if at least you know that that company will probably be in business in 20 years' time because it has some kind of advantages that cannot be copied easily from the rest of the business, you know that at least there will be probably some kind of cash flow, some kind of income. Okay? So you can think that that company will continue to have extraordinary profits, etc. For instance, can you foresee the future cash flows of Coca-Cola in 20 years? Not, but probably there will be some extraordinary cash flows. Why? Because it makes sense to think, we can be wrong of course, but it makes sense to think that Coca-Cola will still exist and that Coca-Cola will have, because of the brand, a differential advantage over the rest. So Coca-Cola will be able to charge an extra price for their products. So as I say here, a moat is a competitive advantage. Yeah, a competitive advantage is a reason why customers are willing to pay an extra price over your costs for your product. Extra price over your cost and over the price of the competitors. Okay. Let's imagine you have two products which are completely the same, but one costs 110 euros, the other 100. If business A does not have any moat, customers will go to business B. There's no reason to pay an extra price for the same product. But if business A has a moat, he can achieve that customers, the clients, pay an extra price for his product. And we are looking for this kind of business, because this kind of business is the one that will achieve larger returns on capital employed. If a business does not have a moat, return on capital employed will tend to be equal to the cost of capital, because of the process we explained yesterday. If a company earns a lot of money, the rest of the companies will copy his business plan, and the return on capital employed will fall up to the point in which it turns equal to the cost of capital. So we are searching for companies with huge amount of return on capital employed, and in order to achieve that, we have to know very well how the business works. This is a circle of competence, and that business must have necessarily some kind of moat in order to protect his extraordinary return over the competition. Which are the kind of moats the moats, the competitive advantages, furthermore, have two dimensions, which are both important. One is how deep is the moat. This is how much an extra price can I charge for my products. It's not the same to have a tiny moat that, okay, you can charge an extra price of 5%, but not of 30%. because if you charge an extra price of 30%, the clients go to the competition. So one dimension is the depth of the moat. The deeper, the higher charge you can impose to your price over competitors. The second dimension is how wide is the moat. This is how much time can the moat endure over competition. Imagine you have a very deep moat, but next year you will lose it because it's a moat depending on a technology advance that next year will be available for everyone. Okay, you have a very deep moat, but in 1 year and a half you will have no moat at all, no competitive advantage. So the kind of moat we are looking at or we are searching is moats which are very deep and moats which are very wide. So moats that allow the company to charge very high prices over competitors and that can charge those extra prices for many years. Okay. One kind of company which we may think that is able to do that, we don't know, but it seems to be in that situation is Apple. I mean, Apple, just for putting some, well, technologically the product may be superior, etc., but Apple, just for having some products labeled as Apple, can charge an extra price over competitors very high, and it makes sense to think that that competitive advantage will endure many years, at least from now, from today's perspective. Okay? So, of modes of competitive advantages do we have? At the end, there are just 5 or 6 kind of modes. So, you can restrict your searching to this kind of modes. You don't have to think on, well, maybe you find someone which is not in the list, but I think that here in the list are all the kinds of modes that you will be able to find. The first one is real product differentiation. This is a company is producing a kind of product which is different to the kind of product other companies are producing. Okay? This mode usually comes from technological change. Okay? I am able to produce some new product, you are not still able to produce it, so I can charge an extra price. The problem of this mode is that technological change spreads very fast, so the modes may be very deep but are not very wide, don't endure much time. Examples of this kind of modes: IBM or Nokia. Nokia, when releases his mobile phone, okay, had a mode, a competitive advantage for many years, but now has completely lost it. The mobile phone has become a commodity that any other company can produce at the same standard as Nokia, and Nokia cannot charge an extra price over mobile phones, because if not you buy another supplier. Okay. Other kind of modes are perceived product differentiation. This is brands with reputation for which you are willing to pay extra prices. Take into account that having a brand does not mean that you have a mode. Sony, for instance, produces televisions, but probably you are not willing to pay an extra price because of having the brand Sony in the television. Maybe some extra price, but not a 50% over another TV set, okay? Or General Motors, or Ford. It's not very probable that you are willing to buy a Ford car even if it costs 40% more than competitors. Ford is not. Maybe you are willing to pay for BMW or for Mercedes or for this kind of brands. You are willing to pay an extra price of that amount, but not for Ford, General Motors, Citroën, etc. So we are looking for brands that push you to pay an extra price for the products. What kind of brands are these? Coke, Apple, Disney, or Tiffany, the jewelry. Just because of having Tiffany in the jewel, even if it is exactly the same jewel as any other, you pay an extra price. Okay, and these are modes that endure or have endured many times, for many times, and for which you can charge an extra price. Another mode is driving costs down. This is having a business model that allows you to produce the products at a lower price, at a lower cost, than competitors. You can have a superior organization. This is, you can arrange factors of production in a way that allows you to produce more efficiently, or you can have economies of scale. For instance, one example is Walmart. Walmart, because of having many supermarkets, he can reduce a lot his logistical costs. So it's not easy to copy the model of Walmart, because in order to copy the model of Walmart, you would need to have already many supermarkets. So, as you cannot start with a huge company from the beginning, you have difficulties in order to attack the mode, the competitive advantage, which is lower prices of Walmart. Then another mode is locking in customers. This is increasing the cost of your clients to switch to other competitors. The cost, it's not necessary to be a monetary cost. It's not that if you go to another competitor you have to pay me a fine. That's not usually the case. The cost usually is some kind of training. Imagine that in order to use some kind of product of a company, you have to devote it some time in order to learn how that product works. So you say, I am willing to change to another supplier and I have to start learning the working of that new product anew. Well, that's a cost that would prevent you probably of changing. Okay? Or if the company is very vertically integrated, you have a company that offers you many services, so you cannot change just one part of the company. For instance, one example is Schindler, the elevators. Schindler not only sells you the elevators, but also provides you all the maintenance services. So, you cannot say, well, I will buy another elevator from another brand, but I want to keep the maintenance service with Schindler. That's not possible. So, if you want to change just one part of your product, of the product you are buying, you have to give up all the integrated services. And if it is not easy to substitute part of those services, the cost of changing becomes huge. And finally, also you can also put here the networks. If you, by changing your supplier, are losing a huge network of interrelations, the costs are also huge. A typical case is Facebook. I mean, okay, I give up Facebook, but I go to another social network. Okay, but the other social network does not have any contacts, so it's worthless. Or okay, imagine you cannot call between mobile or phone companies, and you say, okay, I switch from one mobile company to the other, yes, but the other does not have any phones to call, so the service is worthless. Another mode is locking out competitors. This is usually associated with some kind of government privilege to the business. For instance, you have a license, you have a patent, and you cannot compete with that business. A clear example is the pharma industry. Pharmaceutical companies have patents, so you cannot compete with the products which are patented. Even if you can produce those same products but a fraction of the price, but you cannot because of governmental reasons. And finally, another mode is to have a very competent, a very efficient board of directors. This is some entrepreneurs at the head of the company which can anticipate continuously the events and can improve continuously your product. So you are always two steps ahead of the competitors. And finally, and we can open the question turns after this. Up to now, I have shown you how to detect excellent businesses. This is companies with a large return on capital employed and which have some competitive advantage that may lead you to think that they won't lose that competitive advantage, and then that they can keep large returns on capital employed for a lot of time. Okay, but how do you evaluate the company? How do you give value to the company? How do you estimate an intrinsic value for that company in order to compare it with the market price and to choose whether the company is selling at bargaining prices or not? As I said you yesterday, the way of doing this should be to discount the future cash flows at the current interest rate. This is a mathematical operation that you can do. Okay? But I want to provide you a rule of thumb in order to, with less precision, because the correct way to do it would be the discounting cash flow system, although the discounted cash flow system, you know, that has some limitations because you cannot foresee many of the future cash flows. But if you have found a business with huge competitive advantages, you can assume some progression of the cash flows and some maintenance of the cash flows. But there's a rule of thumb that can be useful to you, which is to using the price-earning ratio. The price-earning ratio is the ratio between the value of the whole company, its capitalization, divided by the profits of the company. That's the price-earning ratio. For instance, if a company is worth in the market 100,000 euros and it is obtaining some annual profits of 20,000 euros, sorry, the price-earning ratio would be 5. So you are paying a price for that company which is 5 times their annual profits. Okay? This is a very important tool in order to value companies, the price-earning ratio. So, if you think about it, the price-earning ratio is just the inverse of the rate of return. Why? Because if you divide 20,000 by 100,000, you have that the rate of return is 20%. You are buying a company which earns 20,000 euros by paying 100,000 euros. So you are obtaining by that operation a 20% return. Okay? So you will have always, well, always not, next session we'll see cases where not, but you will have normally some kind of price-earning ratio. Which is the historical average of the price-earning ratio of the stock market? It's around 15. which is equivalent to a annual rate of return of 7% more or less. Okay, so in order to know, that's a rule of thumb that you should later on work on it in order to make it more precise. But as in general, if you want to know which is the fair price, the intrinsic value of a company, first you have to calculate what's called normal earnings. This is what's the average capacity of producing earnings of that company. You don't have to take a very good year, neither you have to take a very bad year of profits. Maybe you can look at last 10 years average of profits. You have to see if the profits are increasing at a more or less constant ratio. And then once you have an average profit, a normalized profit, you have to multiply that by 15. And then you can have a roughly estimate of the intrinsic value of the company. Okay, you have also to see whether in that industry the price-earning ratio is in general 15 or not, because there are industries where the price-earning ratio is lower, others where it is higher. It depends on the risk of the industry. If the industry is very risky, the price-earning ratio should be lower. If the industry is very non-risky, the price-earning ratio tends to be higher. But in general, the average and the point where all the time the market is converging is 15. So, imagine you find a company which has profits of 100 and a price-earning ratio of 15. Its market value would be 1,500 euros. But let's assume that in period 2, for any reason, the profits fall to 20. Okay? And the price-earning ratio falls to 5. Why? Because if the rest of the investors are expecting the company to lose more money in the following years, the price-earning ratio will fall. Okay? So, its market value will fall to 100. From 1,500 to just 100. So, let's assume that you calculate that the normalized profits, that the normalized earning power of that company is not 100, is not 20, is 50. Okay? And you also calculate that the price earning ratio of that industry is 10, because it's an industry somewhat risky, etc. In that case, the intrinsic value of that company would be 500. If the normalized earning power is 50, the price earning ratio of that industry is 10. 50 times 10 gives you a market value of the company of 500. This means that that company will tend to multiply its price by 5. So it would be a quite sensible operation to buy the company in period 2. So when expecting a company, or when trying to foresee whether a company will increase its price or not, you have to take two variables into account. First, whether their profits will increase, and whether after the increase in profits the price earning ratio will increase. Because what we see many times in the market is that when profits decrease, the price earning ratio also decreases, because the agents are willing to pay much less times their profits in order to buy the company, because they think that the company will go worse and worse and worse and worse, so they are not willing to pay a huge price for buying a tiny amount of profits. Okay, but if you think that the problems are just conjunctural, are not a structural problem, you have to expect that profits will increase, and once the profits are increased and normalized, this is the market again expects the normal profit to be 50, the price earning ratio will increase, so you can take advantage in the valuation of the company, in the market price of the company, from both effects. Having more profits, and that the rest of the agents are willing to pay a higher multiple for those profits. Okay?